God damn it, I paid 25 schmeckles for this. Doesn't even reverse the ionic phase shift. Amateurs.
Rick, look, what the hell is this? I mean, this isn't good, Rick.
Calm down, Morty. It can't be that bad. Morty, do you realize what this means? You've earned too much money, Morty. You've got to earn so much money. You've exceeded your maximum contributions cap. Plus, they're taxing your super contributions at 30% instead of 15%.
Oh, gee, Rick, what can we do, though? I mean, it's not like I meant to do something wrong or anything. Oh, geez.
Relax, Morty. We just needed someone who knows how to solve problems.
I'm Mr. Meeseeks, look at me!
Mr. Meeseeks, can you make this disappear?
Oh boy, Rick, that looks hard. Do you even know what it is?
It's clearly a directive from the Citadel of Ricks. They're coming for us. Taxation is theft.
I'm not too sure about that, Rick. I don't think I'm going to be able to fix these, but I can probably explain why they happened and what you can do to fix it.
So we have two different assessments going on here. The first is because the taxpayers exceeded their $25,000 annual concessional contributions cap. Now that usually happens because of the timing of when the contributions go into their account in their super fund, or because they're on a very high income and their employer has contributed the full 9.5% of that income. If this happens, the taxpayer becomes liable for excess contributions tax, or ECT. This isn't actually a huge penalty or a breach of the law. It just means that those excess contributions get taxed to the taxpayer at their personal marginal tax rate. The extra tax is levied to the individual usually by way of an amendment to their original notice of assessment. But the process is so streamlined nowadays that the assessment quite often takes place when you lodge your tax return, which means that what you lodge to the tax office doesn't match what comes back to you. And this can be a bit of a shock for a lot of people. As the taxpayer has been forced to pay tax on those contributions themselves, the ATO considered that money now to be the taxpayer's money, which means that the taxpayer can then request the super fund remit 85% or up to 85% of those contributions back to them if they choose. Whether or not they do that is a matter of financial advice. So the only actually penalty involved in ECT is that the ATO tack on a small notional interest charge because the funds have been in a lower taxed environment while they've been earning income between when they went into the super fund and when you eventually pay the tax on them. This system's been around for quite a while, but it's become a lot more of an issue nowadays because the contributions caps have been reduced from up to $100,000 to only $25,000 for everyone nowadays. The second assessment is for Div 293 tax. Now that's a tax that was introduced in the 2012-13 year for people who have incomes above $300,000, but that income figure was reduced to $250,000 from 1st of July 2017. And I note that the income figure isn't simply taxable income, it's a number of income tests plus the super contributions that you've made. The idea behind this tax was that the people on the highest marginal tax rate, which is pretty close to 50%, were receiving a much higher benefit from contributing to super than people on low and middle income tax brackets. So therefore they're aiming to equalise the benefit rather than equalise the deduction. So this assessment will usually arrive sometime after your actual tax assessment, and it'll be a separate Div 293 assessment. You'll be potentially taxed on up to $25,000 of contributions at a further 15% on top of the tax that the super fund's already paid. As many people have multiple super funds, the ATO don't know who to send the assessment to, which is why they assess the individual. And the individual can then apply for their super fund to either pay that directly on their behalf or release the funds to them. However, this isn't a case of being able to get the excess or the tax out for yourself personally like you can with ECT. You can only get enough out to cover the tax bill. One of the key things about these assessments is that the relevant documents are quite often being sent to people now via their MyGov account. That includes the documents required for you to get the funds released from your super fund if you want them. As many people don't actively use their MyGov accounts, they quite often aren't even aware that these assessments are there or that the forms to get the funds released are there because they just don't get the notification or don't log in very often. So this can be a big problem because you can end up getting put in debt collection when you're not expecting it, and the release forms need to be lodged within strict timelines of the assessment being issued. So the lesson in that is if you're going to set up a MyGov account and link it to your ATO account, make sure you've got all your communication details up to date and that you do actively go and check it every now and then just in case. So in short, there's usually not a lot you can do about these assessments, especially in the case of the Div 293. They've got the systems down pat so that the assessments are almost always right. But if you do get one, you should always check that it's right. And if you need any advice, go and see your tax agent. Thanks for joining us on the Rick and Morty Knuck Report. It's been great fun. As always, if you've got any questions, stick them down below in the comments. I'm Knuck, and this is the Knuck Report.